Hey everyone, welcome back to Corporate Decoder. Today, Summit Therapeutics Inc. SMMT just filed an 8K reporting a material definitive agreement, and I am seeing one immediate consequence for shareholders. Quick note, this is not financial advice, just my take on public filings for educational purposes. They are setting up a massive share offering that could significantly dilute existing owners. As you know, Summit Therapeutics is a company in the biotechnology sector. They've been working on some interesting treatments. But today we are looking at a regulatory filing that tells us about their financial strategy. This filing is an 8K, which means it reports on major events that shareholders should know about right away. The big news here is about a distribution agreement they have entered into. On July 23, 2026, Summit Therapeutics Inc. entered into a distribution agreement with JP Securities LLC. Think of JP as a big investment bank that will help them sell their stock. This agreement allows Summit to offer and sell shares of their common stock. The really significant part is the amount. They can sell shares worth up to $380 million. That is a huge sum. This basically means Summit Therapeutics is planning to sell a lot more of its own stock to raise money on the open market. They are not forced to sell any of it, but they have the option to sell up to $380 million worth. JP will act as the sales agent, meaning they will find buyers for these shares. The shares will be sold through something called an at-the-market offering. This is a common way for companies to raise capital by selling shares gradually in the open market, often at prevailing prices. JP will try to sell these shares through regular stock market trades directly on the NASDAQ or to market makers. The company will pay JP a commission, which can be up to 3% of the gross sales price. This entire offering is being done under a previously filed registration statement. This is a standard procedure. They already told the Securities and Exchange Commission, or SEC, that they might want to sell more shares, and now they are executing on that plan. They also filed a prospectus supplement on July 23, 26 to go along with this agreement. Let's think about what this means for you as a shareholder. When a company sells a large number of new shares, it increases the total number of shares outstanding. This is called dilution. If you own, say, 100 shares and the company issues 10,000 new shares, your ownership percentage goes down. Your 100 shares now represent a smaller piece of the company. A $380 million offering is substantial, especially considering the company's market cap, which is around $11.6 billion as of recent reports. While it is not an immediate massive dilution event like a reverse split, it represents a move to significantly increase the cash on hand through equity. Companies often do this to fund research and development, pay down debt, or for general corporate purposes. In Summit's case, given the news about their lung cancer data and concerns about financial viability raised by some analysts, this is likely a move to shore up their cash position. Think about it this way. If you had a delicious pizza and suddenly 20% more pizza base is added, your original slice, while still tasting the same, now represents a smaller percentage of the whole pizza. This is what happens to your ownership stake when a company massively increases its share count. This move also signals that the company might need significant capital for its operations or future projects, and they are choosing to raise it by selling more stock rather than taking on debt. This can be a good or bad sign depending on how the funds are used and the overall health of the company's business. Their common stock is traded on the NASDAQ stock market under the ticker symbol SMMT. This offering is happening on the public market, so it directly impacts the shares traded there. This offering is being made under an effective registration statement on Form S-3. This filing is essentially the company telling the SEC that they plan to sell these shares and have provided the necessary disclosures. The prospectus supplement is like the detailed brochure for this specific stock offering. The core of this filing is item 1.01, which reports the entry into a material definitive agreement. This distribution agreement is definitely material. It allows them to access a significant amount of capital. For anyone invested in Summit Therapeutics, this is a key piece of information. It tells us that the company is actively managing its capital structure and is preparing for potential future uses of funds, which could be for ongoing clinical trials, regulatory approvals, or other strategic initiatives. The commission for JP is up to 3%. For $380 million, that is potentially over $11 million paid in commissions. That is a significant cost of capital. So what does this all mean in the bigger picture? Summit Therapeutics is opting to raise a large sum of money by selling more shares. This is a direct move that will likely dilute existing shareholders. While the intention is probably to fund important growth initiatives or cover operational costs, it means your ownership slice of the company will become smaller unless you also buy more shares. It's a trade-off between the company having more cash to operate and grow versus your existing stake being worth a smaller percentage of the total company. The market's reaction to this type of news is often negative in the short term because of the dilution factor. Investors don't like seeing their ownership percentage decrease. However, if Summit Therapeutics uses this capital wisely to advance its pipeline or achieve significant milestones, the long-term benefits could outweigh the initial dilution. Looking at the broader context with recent headlines mentioning fresh lung cancer data alongside concerns about financial viability, this offering seems like a proactive step to ensure they have the necessary financial runway to continue their operations and pursue their drug development efforts. It is a way to de-risk their immediate future from a cash flow perspective. My take on this filing is that it signals a necessary, albeit dilutive, move for Summit Therapeutics to secure substantial funding. The critical factor going forward will be how effectively this capital is deployed to generate value for shareholders. If the funds are used to achieve key clinical or regulatory milestones, the dilution may prove to be a justifiable cost for future growth. However, if the capital is simply used to maintain operations without significant progress, the dilution could be a net negative for shareholders. The risk I am watching is whether this capital injection will genuinely accelerate their pipeline or merely extend their runway without tangible breakthroughs. What I am actually looking for is a clear demonstration of how this substantial funding will translate into concrete advancements in their drug development programs. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, smash that like button and subscribe for more. See you in the next one.